It's been researched that the average millionaire has 7 different streams of income. A lot of wealthy people invest in income-producing assets to ensure various stable income streams. With that, they can ensure consistent money flows into their pockets over time. The amazing thing about these assets is that they're not limited to only investors with a ton of cash. That means that you too can get started investing in these different streams. In this video, we'll show you 8 assets you can utilize to create cash flow and more income. But before we get started, if you're not subscribed to the channel, please hit that subscribe button. It really helps us out a lot. Now, when we say invest in income-producing assets, we're talking about using your money to buy instruments that will bring more money into your pocket in the long run. Let's take a look at them. Number 1, dividend stocks. Stocks refer to shares of a company. When you own a company share, you're indirectly owning a portion of that business, which allows you to make money each time that business makes a profit. Dividend stocks are company shares that give you profit in the form of cash returns from a business or company earnings. Dividend stocks can provide you with a steadily growing income stream, which helps you beat inflation. So instead of leaving your money in the bank to lose its purchasing power over time, why not purchase some dividend stocks that would outgrow inflation? Dividend stocks tend to be less volatile. This is because companies who generally give consistent growing dividends tend to be larger, stabler companies like Walmart, Coca-Cola, and ExxonMobil. Dividends can be an incredible investment, especially when you use the power of compounding by reinvesting profits to help you build wealth faster over time. They also help you reduce investment risk by reducing losses that may occur from stock bear markets, as they generally decline less in value than other stocks. Number 2, bonds. Bonds are simply loans from you as an investor to a borrower who could be the government or a company. When you invest in a bond, you're lending your money to a borrower to fund their operation. They pay you interest in return on your investment. You can also look at a bond as an IOU agreement between you, the lender, and the borrower, private company, or a government agency that includes the principal loan, payment details, and interest arrangements. Bonds provide you with reliable means of income, and if you hold them till maturity, you get back your entire principal. So bonds provide you with the means to protect your capital even while you invest. It also helps you to offset your exposure to volatile stocks that you might hold. It's one of the reasons why most portfolios would advise a mix of stocks and bonds. Number 3, rental properties. One of the most well-known income-producing strategies is real estate investment, specifically owning rental properties. This implies you buy a property and market it to tenants who pay you rent over time. These kinds of investments allow you to produce a stable income. This is one of the most approachable investment opportunities for newer investors because many can start to increase their wealth with their first home. Instead of selling it when they're ready to move, they can begin to rent it out. The dependable cash flow and endless possibilities of earning a steady income can also help expand your portfolio, as it could allow you to buy more properties. You could also decide to diversify within this space by purchasing real estate specific funds, typically called REITs. You don't have to put all your eggs in one bucket to guide you to a financially stable future. Number 4, REITs. The idea of owning a rental property sounds good to you. You're excited about having the financial leverage that comes with a rental property, but then you're confronted with large upfront costs and setup requirements, or maybe you live in a high cost of living area and it doesn't make sense to purchase there. Then real estate investment trusts, or REITs, are for you. Investing in REITs is more like you investing in stocks, but here you invest solely in real estate-oriented businesses. You invest your money in a real estate business that then rewards you with attractive dividends as they use your money to buy real estate properties. You're investing in real estate indirectly without having to deal with the time and setup requirements the traditional investor has to go through to buy and sell physical real estate assets. The most awesome thing about investing in REITs is that you get to accumulate dividends over a long period, which can result in large profit margins. Traditional real estate investors buy, hold, or flip their properties, while REIT investors are passive earners with no physical assets. Number 5, real estate crowdfunding. Before, you could only invest in real estate by buying physical property or investing in REITs, but all that has changed. With crowdfunding, a completely new dimension of investing in real estate now exists. Crowdfunding allows you to join money with other investors to buy a property or a share of the property as a group. You can now raise money with crowdfunding by reaching out to many investors who contribute a small amount of money to meet an investment goal, and the profit is shared among the investors. The good thing is that it can be done from anywhere, as it's usually done online via social media or other designated platforms. Another benefit when it comes to real estate crowdfunding is that it requires a smaller amounts from individual capital compared to traditional real estate. This is good for you as it comes with a minimum entry level. Number 6, money market savings account. One of the most significantly straightforward asset classes for you to generate passive income are savings accounts. Having these types of accounts will allow you to earn revenue from interest on your money. The potential income varies depending on the account type and interest rate, which is between 0.1% to 1.4% of the amount that you put in your account. Although the interest rate is small with these types of accounts compared to other assets we've talked about earlier, it comes with liquidity benefits. That means you can access your money on short notice. Aside from the traditional savings accounts, there are other types like the money market account that can yield you slightly higher interest, but these tend to be held in a brokerage, which means you have slightly less convenience when it comes to accessing the funds. You will have to choose between convenience and higher interest rates in order to choose the saving account option suited for you. Number 7, CDs. When it comes to timing and convenience, certificates of deposits are another choice of an asset for you. CDs are seen as time deposits, though they are similar to a savings account. Here, you as an investor put in a certain amount of money and earn income through the interest that is accumulated over a set time. The basic difference between CDs and savings accounts, though, is that when you invest in CDs, you have to wait until the agreed time before you can access your funds, otherwise you'll be penalized. But these time frames also help to increase your interest rate when compared to a savings account. While the time frame may be longer, there are no or very low minimum to invest in CDs. This makes CDs very accessible to anyone who's interested. Number 8, peer-to-peer lending. Lastly, there's the peer-to-peer lending asset class, which helps cover the lapse of traditional banking systems. Now, this one typically does require a little bit more upfront capital, but it could be a way for you to indirectly invest in other areas. In this asset class, you invest your money by way of lending to borrowers at rates agreed upon by you and the borrower. Unlike bonds, with peer-to-peer lending, you have full knowledge of who the borrower is. Peer-to-peer lending is a really good income-generating asset with a very attractive interest rate. For instance, let's say someone comes to you and asks to borrow money so that they could purchase a rental property. You as the lender can set your specific terms as far as interest amount, how often you'd like to get paid, and when the lender has to pay you back all of your principal, but you never have to worry about the actual rental property. You may be questioning which asset class is best to invest in. The answer depends on many factors, like the initial capital you have to invest, the time frame you're willing to leave your investments, your preferred level of involvement in the investment process, and ultimately, your level of risk tolerance. With dedication, due diligence, and choosing the income asset class that fits you personally, you can get closer to achieving your financial goals. Thanks for watching. If you learned something new today, make sure you like and subscribe to our channel and click on that notification bell so you never miss out on new videos.